Today, we'll be learning about reverse stock split and how it affects your stock. So let's get to it. A reverse stock split is an action taken by a company to reduce the number of its outstanding shares in the open market to create a smaller number of proportionally more valuable shares. As you can see, this definition is a little bit long and a little bit difficult to understand. So why don't we shorten it? A reverse stock split allows a company to increase its stock price by combining its outstanding shares. How do they do this? In this example, a company has 100 million outstanding shares trading at $2 per share, but the company decides to do a reverse stock split of 1 for 10. What this means is that they want to turn 10 existing shares to one new share. Let's look at the math. To understand, the total new share is 100 million old shares divided by 10, and that gives us 10 million total new shares. In order to understand the new price of the new share that you're getting, we'll do $2, which is the stock price for the old share, times 10, and that gives us $20 per new share. It's important to understand that the market capital of the company will still remain the same. If you own the stock of this company and the value of your stock, total value of your stock was $1,000, after the reverse stock split, the total value of your stock will still be $1,000. You will just have less shares with the company. Let's talk about two facts that you must know about a reverse stock split. One is that a reverse stock split has no impact on a company's value. If the company was valued at 20 million in the past before the reverse stock split, after the reverse stock split, the company is still valued at 20 million. The value of a company's stock increases even though it has created zero value. Why do companies do reverse stock split? One, to keep themselves listed in a preferred stock exchange like the Nasdaq or the New York Stock Exchange. If a stock on the New York Stock Exchange trades below $1 for a 30-day period, they risk getting delisted. The second reason is to keep that stock attractive to institutional investors and mutual funds. Institutional investors and mutual funds are high-value investors who buy a large chunk of company shares. So they're very important, but they only invest in stocks that are well priced. Third reason is to get a good price for a company they plan to spin off. Let's take an example here, Uber. Uber has their main business, which is the Uber transportation company, the driver app. And then they have another business called Uber Eats, which is their food delivery business. If Uber stock price used to be priced at $40, but now it's priced at $20, and they plan to offload Uber Eats, it might actually be bad for them because they'll get a low price for Uber Eats. So what Uber can do in this situation is to do a reverse stock split and get their stock price from $20 to $40. And then once they've done that, they then offload Uber Eats, and that would then allow them to get a better stock price or share price for Uber Eats. Now, let's understand how a reverse stock split affects your stock. Immediately after the announcement of a reverse stock split, the stock generally falls. As soon as a company announces a reverse stock split, it's a signal to the market that the company is doing really bad. The situation has gotten out of hand, and that's why the company is trying to create a smoke screen and kind of create a perception that the stock is doing well, even though it is not. Second, trading is normally halted in the 24-hour window when the reverse stock split is scheduled to occur. This is done to give the exchange time to update their system and reflect the new stock price. So if you are somebody who owns this stock, if you want to sell it, you should sell it before this freeze happens. Third, in the immediate aftermath, you are worse off. 4, what happens to your stock in the long run depends on the company's strategy moving forward. If all the company has done is this reverse stock split, then the outlook for your stock is not very good. But if they've done or taken other actions to right their wrongs and to get better, then the outlook for your stock is good. So whether a reverse stock split is good or bad depends on the company's outlook. Let's now talk about a real life scenario. Here we have a stock with the ticker UCO. The stock price used to be $1.35, and the stock faced the risk of getting delisted if it fell below $1. And so this company decided to do a reverse stock split of 1 for 25. And so the stock price went from $1.35 to $33.75. And like I told you, after a reverse stock split, stocks generally falls, and that happened here. Within a day, the stock price went from $33.75 to $13.14. But recently, with the good news of crude oil, where Russia, Saudi Arabia, and OPEC has decided to reduce the supply of crude oil, the stock price has started climbing. So if you're an investor, you might want to invest in this stock, even though they recently went through a reverse stock split. The macro trend looks good for crude oil. Since there's a reduction in supply, crude oil prices are going to go up, and this stock is going to end up doing well. So we talked about some terms in this video, and I want to make sure that I define them before we leave. I hope you found the video educational. If you like the video, please like and subscribe. Have a good one.